values. So remember we went over this lottery example. If you have three options to choose from, you can either get $1 million now, $150,000 every single year for 10 years, or $2 million 10 years from now. So if you want to choose from these three options, we discount the value of those returns to its present value to compare which one is higher than the other. Okay, so option 1 is already this present value. You don't have to worry about that. Option number 2 is an example of annuity. Right, if you get $150,000 every single year, 10 years from now, if you trace back, discount that value to its current date, we'll refer to the present value annuity factor. Use this to time the $150,000. So as of today, this is the total returns worth. So compare this with the first one. This is actually higher. And then option 3, getting $2 million 10 years from now, this is an example of lump sum investment. Right? You don't have additional deposits in the middle. So we refer to another table, which is the PV factor lump sum investment, and then same process, use this factor to time that $2 million to get its current value as of today. Okay, so what we're doing here, this concept here is leading to the long-term assets projects. We'll be tracing back, discounting the returns, potential returns of this asset based on the machine's operations, equipment's usage in the business, trace it to its current value, and then compare which return is higher than the other to find the investment project that the company really wants to go for. Okay? Now this example is just the same lottery example, just switching to different numbers and then different time frame, percentages of interest. Basically the concept is the same. 7 years from now is a lump sum example. You have a current value, the second option, and the first option is getting a recurring amount at the end of each and every year. Okay, so just remember that annuities, lump sum investment, you'll be referring to different tables. You'll be using different factors to find its present value or future value. Okay, so the last section in this chapter, discounted cash flow models, continuing